Hello everyone and welcome to AC115 Financial Accounting. This is your introduction to exactly what financial accounting is. In simplest terms, financial accounting is the field of accounting that focuses on providing useful information for external decision makers. People are going to want to know things about your company, and what we're going to learn this semester is how to meticulously and carefully track everything that happens within a business so that we can provide this information to external parties and help them make decisions. Who would want to know about our company? Well, a bank would. If we were looking for a loan, a bank's definitely going to want to know about our company. Come tax season, Uncle Sam's definitely going to want to know about our company. And if we are selling shares of stock in our company, if we're looking to get external people to invest in our company that aren't banks, they're going to want to know stuff too. What exactly are they going to want to know? Well, let's look at the bank to start with. The bank's going to want to know what is your ability to repay debt. It's very unlikely a bank's going to give you a loan if your company's losing money every period because you're never going to be able to pay it back. You get a better interest rate on your loans if you put something up as collateral. So what assets, what business items do you have that you can use as collateral? Do you have equipment? Do you have a building that you can put up, etc.? And what other debts do you owe? Again, a company or a bank is going to be much less likely to give someone a loan if every other bank in the area has also given them a loan because they're going to be buried in debt. So these are things that a bank is going to want to know about your company. What is the IRS going to want to know? Well, they're going to want to know, namely, what do you owe in taxes? How much taxable income did you have? They're going to want to know what taxes you paid. Are you paying the proper amount of taxes? And what size is your business? Are you a very small business doing a couple $100,000 a year in revenue? Are you a medium-sized business doing a few million, or are you a gigantic business that's doing billions of dollars a year in revenue? Because depending on the size of your business, there's different ways that you have to account, and there's different ways that you have to file your taxes. And investors, what are they going to want to know? Well, they're going to want to know how much profit did you make. That's why people are going to invest in your company, because they think you're going to be a successful company and you're going to give them some of that money back now that they are technically the owners of your company. Are you going to provide a return on their investment? If they buy into your company, if they give your company money, are you going to use it constructively in order to make a profit? And lastly, how does your company's profitability compare to other companies? Investors have the option of investing in any company they want to. So they're going to want to know, how do your numbers compare to someone else they can invest in? They're going to make as much money investing in you as they could in another company. How do we convey this information? It would be really crazy if we could just do whatever we want to tell people stuff. It'd be very hard for people to go through and look at all of these documents. So what's the best way to convey this information to people? And it's through financial statements. Every company makes the same set of financial statements. Maybe there's some small variance between them, but the big three financial statements every single company makes. And they start with the income statement. Well, what is the income statement? It is a document that shows an external party who wants to know something about your company, how much revenue you made, which is, if you're a service business, how much you did in service. If you're a sales business, if you're a retailer, how much sales you did during the period. How much money are you bringing in from doing the normal course of business that your company does? Also, they're going to know what bills you paid, what were your expenses for the period. Are you doing a good job of minimizing the costs of your operations? Because ultimately that's going to determine how much profit you made, which is the money left over at the end of the period after all of your other stuff was accounted for, which can be used to reinvest in the business, or it can be used to give money back to the investors that put money into your business to start with. The second document that we're going to have is the statement of owner's equity. And the statement of owner's equity tracks growth in the value of the business. And there's a lot of different formats for this depending on the structure of your company. If you are a publicly traded company that has tons and tons of stockholders, you need to set this up differently than you would if you were a partnership with just a few partners that ran a business. Fortunately for you guys this semester, every company we are going to do is going to be a sole proprietorship. There's going to have one owner. So that one owner is going to have what they call a capital account. And it's going to be the worth of the business is the same amount of stake that owner has in the business because they're the only owner. So the statement of owner's equity is going to show how fast the business is growing. They're going to show, is the business making income? And is the owner reinvesting in the business? Are they, working and putting the money in to make the business grow and become bigger instead of just siphoning money out of the business for their own personal use. So the statement of owner's equity gives external decision makers all of this useful information. And lastly, and the big one, is the balance sheet. I know there's some crazy numbers up on here, but essentially what it is a statement that shows investors what the business owns. That's your assets, the things you can use to make money in the future. What does the business owe? Those are your liabilities, things that you owe to other companies, any bank loans, any bills to, say, a utility company, etc. And lastly, what is the net worth of the business? And since we're sole proprietorship, that is our capital. So this company right here, Luscious Landscaping, has a net worth of $35,575. That is what the business would be worth if they sold all their assets and paid off all of their liabilities. That was what would be left over. It is the value of the business. So back to our original question. What is financial accounting? Well, the big part of this definition here is the term useful information. What makes information useful to an external decision maker? Well, for it to be useful, it has to be four things. It has to be reliable, and that means that what you're saying actually happened. There's substance to it. You have receipts for the purchases you made. You have some kind of payroll ledger for the amount of money you say you're paying to your employees. You have to substantiate it. You have to prove that all the things that you're saying actually happen, and you're not just making stuff up to make your company look better. It has to be objective, so it doesn't favor one party over another. You can't produce your financial statements in a way that, stops you from paying taxes at, the detriment of your investors who are going to see you be as profitable as possible. So you have to have financial statements that help everybody, that they're generally useful to everyone. Verifiable. Some other accountant could come in and, given the information that you use to compile your numbers, would come up with that same exact number. And then comparable. You're presenting your information in those financial statements in a way that it makes it easy to compare to every other potential investment investors have, or any other company that's looking for a loan in case of a bank. So, who determines what's reliable, what's objective, what's verifiable, and what is comparable? And that starts with the Financial Accounting Standards Board, or FASB. And what FASB does is they set the rules. So they say if you're going to make, say, an income statement to show external users how much profit your company is making, this is the format you have to use. If you want to know, how do you account for the loss of value, say, in a car that your company purchases? Well, these are the rules that you have to use to account for. So they are the rule makers. They go through and they set the rules that all companies have to use. And those rules are called the Generally Accepted Accounting Principles, or as everybody refers to them, GAAP. So FASB is the organization that makes the rules. The actual rules are called GAAP. But FASB just makes the rules. They don't have to go out and make sure that everyone's following those rules. They have their own separate institution that, for the lack of a better term, is the accounting police, making sure that people are using these accounting standards that FASB is setting. And that is the Securities and Exchange Commission, or the SEC. They enforce GAAP. They look over companies' financials, and if those financials don't adhere to what FASB said you have to do, they say, no, you cannot release these financials, you can't use these financials. And here's the big caveat on this. SEC only has jurisdiction over publicly traded companies. If you're going to sell stock, you have to perfectly adhere to the generally accepted accounting principles. If you're a small mom and pop shop, you're a barber shop, you're a corner grocery store, something like that, you don't. But you have the option of doing so. And if you have the option of doing so, you probably should, because when you bring your financials to an external decision maker, they're going to say, hey, look, this is in accordance with GAAP. We can trust these. Yes, we'll give you a loan. Yes, we'll give you, investment in your company to help it grow, etc. So for this class, even though we're going to be small businesses, we're still going to always adhere to GAAP principles, because there's no downside in not